The single biggest concept that most people miss out on when investing is diversification. There are a lot of people I know who get into investing and invest in one particular company that they like. This comes with more risk than investing in a number of different companies, right? And the thinking and rationale behind that goes like this. You invest in one company, all it takes is kind of one employee at the company doing something that ends up in the news that can really negatively affect that company's value, right? Maybe it's the CEO gets in a scandal, some employee comes out, maybe with a gripe and ends up talking about some underhanded things going on at the company. Maybe it's even bigger than just one employee. But the point is, when you invest in one company instead of many companies, you are taking on additional risk. Now, even if you did invest in many companies, there is still risk that comes with investing, right? Those companies, on average, or even all together, could have bad results, bad performances, could end up losing you money. But another way to think about it is think of the chances that one particular company that you really like may lose money. Now, think of the chances that you invest in 10 companies that you like and they all lose money. What's much more likely than all 10 of them losing money is some do well, some don't do as well. Maybe some make money, some lose money. But overall, you're not experiencing the same up and down swings by investing in a broader group of companies than just investing in one. To even kind of explain this further and give another concrete example, right? One company investing tends to have more risk than one industry investing, right? Because we said one company, all it takes is one employee, one bad news story about that company, and then the stock price can tank. When you invest in industry, you're still kind of buying into this idea that maybe this is a technology for the future or a product that people are really going to need, or that there's really an opportunity there. But it isn't just one bad news story about the company that can affect things. But in that situation, maybe it's a politician proposing a new law that would affect that industry, and then all of the companies in that industry are now looking at a different, potentially more adverse future because of it. What's generally less risky than investing in one industry is investing in multiple industries. You've probably heard Warren Buffett and many other financial experts talk about the S&P 500. Really, if you probably have watched any stock market analysis at all, you've seen the S&P 500 ticker going across the bottom of the screen, right? There are many, many companies that don't get that same level of exposure, right? That is generally considered like the baseline or the gold standard that people compare other investments to. And that is because the S&P 500 being 500 different companies across a whole swath of industries is a diverse portfolio, is a diverse selection of companies. So people that know that you can diversify and reduce some of the risk associated with investing look to the S&P 500 because it has that diversity built into it. Right? When people talk about the stock market and whether it's up or down, oftentimes that is a reference to the S&P 500 and whether the S&P 500 was up or down, right? It's sometimes like synonymous with the stock market. It is because of this idea of diversification and how diversification can reduce risk. And this idea of diversifying and to reduce risk is not just limited to stocks and investing in companies. It can be in terms of your income stream, right? Maybe you have a 9 to 5 job, but you would like a side hustle where you can get a little bit more money on the side. That is a buffer so that if something were to happen with your job, you still have this other option that is viable, right? If the money from the job goes down, well, you still have this money from the side hustle that won't be affected in the same way, right? If you get laid off, if the company closes, those hours get cut, those sorts of things may affect your main job, but they wouldn't affect your side hustle in the same way. And if it's a side hustle, sometimes you can even scale it up as a counterbalance against what happens in the job. Maybe your job starts paying you more money, you cut back on the amount of time you're putting in the side hustle, right? This one goes up, you decide, well, I don't need this one as much, I'm going to bring that a little bit down. Maybe the hours get cut or you get fired from the job or there are layoffs. You start working the side hustle a little bit more, right? One goes down, the other one goes up. It's to help bring about this balance so that overall you are prepared for a number of different situations, a number of different outcomes, a number of different risks, and you can still navigate them effectively. The same thing can happen with assets, right? Maybe you have a house and a car and a bunch of stuff in your house, furniture and computers and TVs, right? Well, maybe you need the car to get back and forth to work, and you need a place to live. So maybe if you come across tough times, maybe it's, well, I'm going to cut back on some of the expenses within the house. I'm going to cut off some of the streaming services. I'm going to stop eating out as much, right? An adverse situation comes by you having these different options. You don't just have to immediately sell the car and start taking Ubers or something else, right? You don't immediately have to sell the house and get money from there to make up for a potentially bad situation. The same thing is even with like life insurance and savings and car insurance, right? You have these, you buy into these insurance policies so that if some bad situation happens, it's not such a big hit to you in that particular time, right? You buy the car and you get the car insurance. Something bad happens with the car, then the insurance is supposed to come in and help out. You buy health insurance so that if your health is affected in a bad way, the health insurance comes in and helps pay to get you back up on your feet, moving again. You have the savings account so that some big expense comes out of nowhere, you got money over here to help make up for it. These are different ways of reducing risk by diversifying your portfolio. And it's not always a portfolio of stocks, but it is a selection of different financial assets or investments or opportunities that by having them together ends up leaving you in a better place if there are swings, right? Uncommon events that come in and happen, and uncommon things, even though they are uncommon, do and will still happen. So, diversifying your portfolio is an important way that you can reduce risk as you are investing. Now, it doesn't mean necessarily buy into every company everywhere all the time so that, you have the most diversity possible, right? You will still have to decide how much risk you want, what your investments will be, but you can reduce some of the risk by diversifying. So, I hope this finds you well. I hope you take care, and I love you.